Welcome to our CFA audience, the CFA charter holders, all of our guests, all of our friends of the program. This is another episode of Macro Matters. We're back here on October 22nd. And since we last met a couple weeks ago or so, before earnings had really kicked off, et cetera, we talked about a lot of different topics, but we're here again to cover what's evolving in the landscape. And my name is Rich Excell, and I'm lucky to be joined by co-hosts Blaine Reed, Tony Zhang. Welcome, you guys. Good to see you guys again.
Hi, good to see you, Rich, Blaine. And over the past couple of weeks, there were so many things happen, and we do actually see some very interesting developments in the macro, which might actually have a huge impact for the trajectory of the market going forward for the rest of the year. So will be very exciting to actually discuss with both of you in this section.
Hey, Rich, Tony, glad to be here. Looking forward to the discussion. So, yeah.
So we touched on a few things last time. We talked on, First Brands and Tricolor were just kind of coming out at that time, talking about private market. But now we've seen some bank earnings and some regional bank earnings. And not only has the weather gone from 80 degrees to 50 degrees since the last time we met, but there's elements of the market that are cooling off as well. You like the way I did that there? I kind of that segue. But I wanted to share my screen because I think one of the things that where we've maybe kind of touched on this before is like the different narrative, if you will, within the markets, right? We're looking at the bond market and the stock market have had, in my opinion, and correct me if I'm wrong, a different view of the outcome for the economy, right? I would say both markets agreed that inflation was generally low enough and probably not moving up so that the Fed could, everyone felt comfortable with the Fed cutting rates, inflation is contained, et cetera. But the difference to me was that the bond market felt that we were going to go into a recession, that labor weakness was showing signs of, trouble in the economy. And we can see that in 10-year yields falling. 10-year yields this week have tipped below 4%. Whereas in the equity market saying it's, Fed's cutting rates, no inflation, we've got data center growth, AI productivity. It's all about growth, and it's good growth with no inflation. We're at the top, and then we had the other markets like metals and crypto, et cetera, kind of talking about the debasement trade, things of that nature. But here's a chart that I have up here, just kind of describing what I have on these lines. The white line is the 10-year yield. As we see it, it's at 3.95 basically as we kind of talk today. The blue line is the ratio of Bitcoin to gold, which might seem strange to some, but to me that's like looking at the risk appetite within the debasement trade, because Bitcoin being more highly volatile is a little bit riskier than gold, even though I think they're driven by the same things. And then the orange line is the NASDAQ, which keeps chugging and is still near all-time highs. And you can see that when we had a little bit of a concern on growth back in April, yes, bond yields fell. Yes, the growthier parts of that debasement trade, Bitcoin really fell relative to gold, and the NASDAQ fell. But what we're seeing this time is that, bond yields are falling, Bitcoin's falling relative to gold, but the NASDAQ's still holding on up there. So maybe, Blaine, I'll go to you first. When you see something like this, we kind of talk through that as a potential narrative. What are your thoughts as you?
Rich. Yeah, this is certainly there were actually huge debates with regard to what are really driving the divergence between the bond market and equity market. We actually have seen a divergence since pretty much like early July, something that what we are seeing here. And the development, the narrative apparently for the equity market, as what you just pointed out, will really hinge on the huge capex into the AI, which people might believe that in the future would actually change the productivity of the company and simultaneously increase the earning for the major AI-related company. And we are getting into the phase 2 of AI adoption, which actually shifted from the focus from the infrastructure spending more to the application layers, as what we have seen. Now, apparently, over the past 2 to 3 months, after the phase one, at the beginning of this year, that like Magnificent Seven actually lead the market. Different from that, phase two will be the AI related focus on like the crowd service, the SaaS company actually start to take over the token, and this is what like equity investors are highly believe in, and apparently that lead us to look at what will the earning would show us. Apparently, the earning right after our meeting today will be the earning coming out from the Tesla, which will be the focus of equity market certainly. Now here with regard to the bond market, this is a couple of things that might be actually coming in, and when you show the actually relative basis, the Bitcoin versus gold. This is also very interesting. Apparently, gold keep reaching to the new high. That's have a lot of issues like pointing towards that. And people, especially I think the global investor who worry about who actually might not actually allocate the capital into the treasury here. They might actually prefer to buy more gold, such as the government from Asia, including the China and Japan and India, etc. So those countries would favor the gold investment. They actually shovel, they pretty much just like a shovel more of the like reserve into the gold rather than actually buying the treasury here, which actually leading to the high price of the gold. And very interestingly, now it's like we see the yield actually coming down. The long-term bond yield is actually coming down. This is actually another like a story. People might have heard about the report about some whatever institution from Cayman become the largest buyer of U.S. Treasury. Now, not the government sector, right? It's like this is actually driving down. Driving out the demand for the treasury for long term, even though we do not know who are actually on the Cayman are buying the U.S. treasury. But here, this is also the second thing, as we point out, people might not worry too much about the inflation as what we continue to see here. I would actually tend to agree with many folks. Like once we actually, this is something my theory as well as the AI replacement theory. As AI adoption continue, we will actually see more of the layoff coming up, which will be a deflationary factor by in nature. The faster the AI adoption, the faster or the slower of the new employment might be actually coming in, and simultaneously will cool off the demand from the normal consumer, which actually slowing down the inflation. So here, I would not say that the bond market will project it. Right now, we are getting into a recession. Probably might not be the case. I would say it's like we will project the cooling of the inflation, or at least less concerning about the inflation. And given what happened in the past 2 days, that Ukraine and Europe, EU might actually reach a deal with Russia to set up the peace agreement, for ceasefire. There's something is still being developed. I would not actually like hypothesize what might be coming out, but it seems like a lot of, at least from the financial market, people already anticipated that we are going to see a ceasefire, and that's leading to right now the sell off the gold. And something we can actually talk about. That's why you see a pickup of the Bitcoin versus the gold markets over the past couple of days. There are a lot of things going on. I also want to hear how you think about it. Yeah.
Yeah,
Right.
Blaine, what do you think? Because I don't know who's going to pay $20 or $200 for their open AI license if they don't have a job, but we'll get to that maybe later. So Blaine,
Yes.
Tony's debunking my narrative. What do you think about the narrative that's going on in the markets?
Yeah, when I see this chart, I see it as a tale of two charts. I look at that first part of the year when you can look at the white line, the Treasury 10-year Treasury yield and the NASDAQ that were more in line. And I think we entered the year concerned about administration and new policies, potential tariff policies, and the impacts to growth. And I think we saw that kind of obviously bottom out in April. Uh, Things kind of came back, and then late summer, we started to hear the drumbeat of concerns over jobs. And I think at that point, the two markets, as you kind of pointed out, Rich, diverged. The equity markets kind of are looking at you know, AI and growth and, potential lower rates and, all the productivity we're going to get, and it's onward and upward. Whereas I think the 10-year is indicating that, we might, with this slowness in jobs, potentially have a slowness in growth. Maybe not necessarily a recession, but certainly growth expectations that are probably kind of being rebalanced or relooked at. And I think so. I look at a tale of two different themes at two different points of time. And I think you're right to point out that the markets are now kind of diverged in their view. So.
Yeah, and just to kind of build on that, I mean, when we talked about the synchrony, if you will, of the markets early in the year, stocks moving higher, bond yields moving higher. That's obviously bonds moving lower. That negative correlation between stocks and bonds is what a lot of portfolios are built upon, right? The 60-40, the risk parity, et cetera, is counting in some ways on that negative correlation. Now we're seeing stocks up, bonds up. And we've seen stocks down, bonds down when inflation was a problem back in 2022. Stocks up, bonds up, because again, you're really pricing in the best case scenario, and what potentially derails that would be if all of a sudden growth isn't what the equity market investors think, right? Or if there is some signs of inflation, which would negatively impact both of those markets. And so to me, I think sometimes when we think about when we look at these headline equity indices, and I think sometimes they can give us a bad signal, right? Because as we know, there's a fewer and fewer names, only a handful of names that are really driving all the indices, right? And so one of the things I wanted to, and Blaine, we'll start with you this time. Looking here, I have a chart up of the S&P 500, looking at the different sectors or different industries, level one industries, and this is just over the last month. So you would look at the S&P 500 near all-time highs and think the equity market is like, this is great, everything's great. However, you look at over the last month, at the top, the only the positive sectors are healthcare, utilities, and consumer staples, the most defensive sectors, and the market overall is flat, right? Healthcare, utilities, consumer staples, the most defensive sectors. And at the bottom of the stack, you see financials, communication services, which is like Meta, Facebook, materials, consumer discretionary. So the very cyclical sectors are all down, and pretty big. 2 to 3% for a month is a pretty good move. And the most defensive areas are up 6% in healthcare and utilities. That tells me that beneath the surface, the equity market's getting kind of nervous. But Blaine, let me get your take before I get the optimistic spin from Tony.
Yeah, no, well, I would agree with your take, Rich, and I think your point is very well made. You got to look below the surface. You can look at these headline numbers and on the equity side, and it is certainly the case that certain companies have an outweighted trajectory on the overall index. But when you look below the surface, to me, what it looks like is there's a rotation potentially going on between things that are going to be impacted if we do have slower growth going into more defensive type sectors that are always in need, always in demand, so to speak, if growth slows. So, and I think that's that's what this chart is pointing out. So yeah, very good point to make here. So.
That slowing of growth is coming, I think, because of these credit concerns that we highlighted in the last macro matters that have continued on apace. Again, the question is, are those all one-offs, or is there something more systemic going on? And I want to look at the credit markets in a second. But Tony, first I want to get your take on this very clear sector rotation we've seen over the last 1 month.
Rich and Blaine, I agree with both of you that definitely this is a very short-term sector rotation. However, that does not change my projection of the rest of the year that we will still continue to have a bull year, especially in the large cap tech space. The reason for the rotation is not surprise that we pretty much have had a very nice bull run from the bottom in April to right now almost like a 20% up in even S&P 500. So that was pretty much is one way round, about 40 or 45 percent of return, depends on how you actually measure it. So there have been a lot of profit like accumulated on the tech sector, communication sector, and technology sector. So I wouldn't be surprised to see like a minor profit taking. And given those defensive sector, which actually lists over there, like a healthcare and utility and consumer stable, we will look at them differently, because this is what you pointed out. So we actually should single out the utility sector. Utility sectors, the performance actually is driven up by the AI play as well. So everyone knows that the higher demand for electricity for the data centers that have been massively being constructed or built within the US actually drive up the demand for all kind of electricity utilities. This is something that what we have seen over there, and especially we look at the like the earning announcement by the utility company like AMH today. It's like the growth was phenomenal, almost like on a 40-50% on earning per share growth rate. This isn't something that we see normally in this kind of a utility sector. So that's something that we should actually separate the utility sector from what we used to describe as more of a defensive sector. Now here, apparently, it turned out to be utility sector will become a growth sector, or growthy sector, if we continue to see the mass of the adoption or like the demand from the AI here, especially the Stargate project, is the national security relevant project. I think no one in the US can afford a failure within the AI competition with other countries for the rest of the century. So this is very, very important. Healthcare, consumer stable, real estate, definitely some people worry about. Maybe we are reaching to the high, so this is taking some profit and then shifted over to some defensive sector in the consumer staple, or not surprised. And also very, very interesting, like given the latest run of the government shutdown, we probably might see the longest government shutdown in history here. That actually put people nervous about whether the market will be, the bull market will be sustainable. Okay, this is something that's why people is willing to take some risk off and get into the consumer staple and healthcare. Real estate apparently are more of a driven by the higher perspective demand if the Federal Reserve have to lower the interest rate even in a couple of days. So different performance over there. But overall, nothing has already changed the fundamental for the AI adoption from all my observation so far. And apparently we can continue to see the earning from the Meta, the Google, those kind of Magnificent Seven company in a couple of days. But here is my final take. I would say that with every things on behind the AI adoption, AI had been put into almost like a national security matter, and it will continue to go from here. And I do not see it's like too much of the downside. So here would take still, if there will be a big sell-off over the market, that will still be a great opportunity to continue to buy in. May I be too optimistic?
I take a lot of your
right?
points. I would, if we think that we need the government for the bull market to continue, we're in far worse shape than we ever thought we were before. Because if the government never opened, I think we probably would be better off. But and on the utilities, I hear your point. Except for it's not just that growth that you're talking about is only in the unregulated utilities. It's the regulated utilities that aren't going to benefit from that growth because they have to go in front of their board, the utilities board, et cetera. The real estate utilities, regulated utilities, were, that's an interest rate play, right? Their cost of capital is coming down, and that's what's benefiting them. But the healthcare and staples is clearly defensive. But Blaine, what's your take? I mean, it's clearly, the equity market beneath the surface clearly seems to be worried about credit, about the extension of credit to consumers. The bad loans. What does that mean? That means banks may step back from their desire to loan out. Consumers may not get access to loans. Maybe the consumer is weaker than we thought because of what we've seen with autos, like we talked about with Tricolor. There definitely seems to be the market saying that credit markets are feeling a little nervous. Are you getting that sense from what the credit indicators that you look at?
Yeah, I am. And I think, in my past experience, by no means am I saying that we're heading into some sort of a deep, credit crunch or some sort of a negative cycle, but certainly these things are worth paying attention to because, as the old saying is a canary in the coal mine. Usually when there's one, there's others, those types of things. So I think when you look back over the last, call it 18 months, and the abundance of credit that we've had, the easiness of credit, you know, things just we in the industry we talk about how loose things are in the credit underwriting standards, and you've got so many deals coming through the market, and there's just this demand, whether it be from private credit or the retail funds, CLOs in my space, my world, that are demanding these assets. That at some point there should be a little bit probably of a pullback, and when you see things like this happen, I do think you're going to have portfolio managers and analysts kind of take a look, especially those that have been around and been through cycles like this before. You always kind of hit that point of tilt. I'm not sure that we've hit it yet, but certainly when you do approach those tilt points, you start to see things like this happen. And since we last talked, we had the regional banks that were invested in some mortgage funds that, going back, looking at their, collateral being stripped away, things like this that just, kind of how does this happen type moments that they're having to deal with. I think investors are going to look and be a little bit more cautious, about going forward. And so, yeah.
Yeah, Texas
Well,
auto
Blaine,
loans, California real estate. We've seen not large problems, but problems percolate in various parts. But
Yeah.
I have the chart up here of credit spreads, and again, this is just a generic Moody's corporate average versus the Treasuries, 10-year Treasuries, and it doesn't, it hasn't gone as low since the Liberation Day as it had before that, but it's not stressed by any standpoint.
Yeah.
But Tony, I want to get your thought because there's another chart that I wanted to bring up that we had a little bit of a bounce today, perhaps, but the price of oil has been falling, and we're kind of at the year's lows, which are the lowest we've seen going back to COVID levels, and the narrative in the oil market is that the market is oversupplied, and the oversupply is not because of an increase of supply from everyone. It's because of falling demand. And with fixed supply, you're seeing almost 4 million barrels a day of excess supply, which is weighing on the market. Another market, this one, the commodities market now, telling us that growth might be falling in spite of all that energy that's being absorbed and used by your AI data centers, Tony. The oil market is telling us that maybe we have some risk of growth slowdown here. So what's the optimistic spin on this one? Is it just that oil prices lower, gas prices lower, consumer without that job because it got replaced by AI can now afford to have Christmas again?
Yeah, this is whether we have going to have a rich or poor like a Christmas party. This is actually hinging on apparently the index and also the paycheck that normal citizen would have for the daily job. Now, before actually touching on this, I also want to make an additional comment from what Blaine just brought up, I think, which will be very important, and that was we saw the credit crunch over some regional bank, certainly for sure. And if Rich, you can brought up the repo program by the Fed, like we can see the reverse repurchase agreement (RRP), the balance right now on this pretty much on the balance sheet of the Fed has risen to extremely low. That is a good indicator about the liquidity available in the market at this moment. And this we might see some tightening of the liquidity over the market, maybe for the short amount of time. That being said, if Federal Reserve does not take a more of a dovish stance over the next couple of weeks, we might continue to see some kind of a bad news from the regional bank. This might be happening here and there because even though the Federal Reserve continue to release a lot of the tools that they use to actually provide the liquidity to the bank under stress, we have seen the balance actually increase from that sense as well. So this is something that definitely set up a warning, the red flag, or not red flag, or yellow to red flag to a certain extent. So this actually might be some concerning factor to me here. But if Federal Reserve wasn't actually showing the dovish stance maybe in the coming week. So that's something that I would be concerning. Now, coming back to the point about the.
Let me just jump in there because I've seen the same things on X when people talking about the financial market plumbing and the stress there, and when I call up my colleagues that have worked in that industry for quite some time, they tell me nothing to see here. It's a complete nothing burger. There is no stress. There's some spread widening in certain niche areas because of year-end effects, but there is no stress in the market. And I just bring up the global financial stress index, which that's one of the many things they measure is the financial market plumbing. And there are no signs of stress whatsoever. So I'm one to always try to find the bad in everything, Tony, but I can't find the bad in it.
Definitely, Richard. I actually was a little bit confusing about this point here. I also check about this, like the global financial distress index here, but here something that's something happened over the regional bank. But however, here that actually causing the financial almost the whole industry actually falling off like a 3 to 4%, which was rare over the past 5 years, and that's put me into some concerning, more of a concern here. But here I do not see anything, so that's made me wonder: are there any areas that have been overlooked or underestimated by the market? But coming back to the original things like the demand for oil and apparently the oil price have so many factors. Demand and supply of apparently is very, very important. And given the current the administration favor on the domestic like the dig policy, here we will not be surprised to continue to see the oil price continue to go down. It's not purely just because of the demand is weakening, and demand might still be there. The other thing is from the global geopolitical tension had been eased, had we actually seen the ongoing development of the peace package, a deal that had been made at Middle East, and coming up the peace deal between Russia and Ukraine, probably we might see some kind of a risk factor to ease off that will drive down the energy price coming off. But that's actually good for the normal consumer anyway. So that's another sense that will actually drive down the inflation on down to the road. Regardless whether we like it or not, I think the AI adoption is accelerated in the United States, and there are actually a couple of researchers. I also doing the research within the space, like AI replacement and or AI's impact over the job market. And what some of the research from the Harvard, what they have identified over the past 2 years, it was actually the company they actually slow to hire or recruit new fresh graduate, but rather than doing more of a layoff. But I think these things might actually started to change over the next couple of months, that we might actually start to see that company once they adopt the AI, they maybe start to focus more on actually laying off the existing employee rather than actually coming up slowing to hiring the new fresh graduate. I mean, the wasn't a good news for a lot of the college recent college graduate here in the United States, but that's something that no one can actually reverse the curve. That's just in my pure opinion. There's a lot of there's a lot of debates over there, but this is something the trend will continue to see eventually. That will lead to the government have to make some decisions how we actually going to actually deal with the social impact of AI innovation here.
Yeah, so I just overlaid on that oil chart the supply demand, and it's pretty clearly the falling demand here.
Yes.
I don't think that I don't think this has anything to do with geopolitical risk premium. Sorry, I don't think there's been geopolitical risk premium in the market for quite some time, actually. So I mean, I don't I mean I know that the positive spin on labor has been the no hire, no fire. It seems hard because when you see a lot of the AI startups and AI companies, it's clearly aimed at the ROI for those companies is to replace people. And I just, again, without jobs, I don't know who buys stuff ultimately.
Yes.
But Blaine, I want to get your take because I think to me,
Yeah.
the thing that can change the narrative would be earnings, right? And earnings on
Yeah.
more than just tech companies. And we are in the first of two very, very busy weeks for earnings, as Tony kind of mentioned before. Here I have up the earnings analysis just for the S&P 500. We've seen about 20% of the companies in the index reporting. And, you know, looking at the surprise level, you know, the pretty much across the board, the sales or revenue surprise is positive, not huge, 2%. And the earnings surprise is also positive. It's about 6.8%, almost 7%, which if we look on the lower left of this chart, you can see that the sales surprise is about as high as we've seen the last several, last 8 quarters, and the earnings surprise is pretty much in line with what we've seen the last eight quarters. And so only 20% of the way in, but right now earnings across the board, we look pretty solid right now. Blaine, is that going to be the all clear that we need and for the equity markets and for the growth narrative?
Yeah, I'm gonna comment really on that oil chart really quick, because
Sure.
I don't claim to be an oil or commodity expert, but when I look at that chart, just as someone from the outside, I look at that being in a multi-year downward trend, and that to me would indicate there's some other, like you were saying, Rich, geopolitical concerns are kind of idiosyncratic and they happen, but this looks like it's something that's been playing out for now a few years on a downward trend cycle. And I would, the first thing that comes to my mind is just growth, concerns about, growth and the need, state of the consumer, all those things that kind of feed into that. So it just, one point
I hear you. And I mean, I think the positive on lower oil prices is always lower gas prices, more money in the consumer's pocket.
Yeah.
But to the extent that people are driving to work less, or maybe even don't even have a job to drive to, I wonder if that positive aspect of lower oil and gas prices is even felt as strongly as it has been in previous business cycles.
The feed through dynamic is different. Yeah, absolutely. Yeah.
And could be also a good contribution for the lower inflation. And apparently, I wouldn't be surprised the demand.
Market, but Tony, neither market cares about inflation. Inflation, that's like, it's so 2024.
Well, that's actually
Only
good.
Rich Excell cares about inflation. No one else in the market cares about it.
We do, actually. The Federal Reserve does. So that's why we care.
No, Jackson Hole, the Fed said we don't care about it anymore. We're not even talking about it.
Well, I think that yes, to a certain extent, that they have been influenced by the politics here, regardless whether they like to admit or not. But this is something that's gonna happen,
Yeah. On your earnings chart or graph here, Rich, I would concur. I mean, what I've been seeing and reading is that companies, are beating higher than anticipated. You see that in the earnings surprise. You see that in that sales surprise. We're still early innings here, and we have some other companies that need to come through the pipeline. To me, I go back to what we were talking about earlier in the summer, and we kind of beat the tariff thing to beat the drum on that quite a bit, and we just haven't really seen the impacts. I mean, if you look at this, you go, things are kind of progressing, along, and I just wonder going into 2026 if we're going to continue to see that or not. How companies are um, you know uh, taking things in margin. Maybe they're able to cut expenses, helps things down the line. But this is a bit surprising to me, the how well we've done, and it just shows the state of the consumer is still somewhat strong. And until we start to see those, we have seen, I think, some indicators on the strength of the consumer about maybe some auto loan numbers, delinquencies and things like that over the last month and a half, state of the consumer on credit. But this seems to be pointing that things are kind of plugging along well.
And for all the Sturm and Drang about financials and all the losses, et cetera, as you can see, top line and bottom line within the financials aspect of the S&P 500, it's clearly led by JP
Yeah.
Morgan, but we've had half the banks report already, and it's pretty widespread that the banks are doing just fine, right? And they're near the top of the heap. So Tony, earnings, I mean, they're good looking. I mean, they're already optimistic. So I don't know how you're going to put an optimistic spin on what's already an optimistic spin, but go for it. What do you think about the earnings?
I think the earnings so far definitely still shows like a healthy thing. Apparently not better. Apparently it's better than analysts expectation, because analysts have been very conservative about the estimation for the rest of the year, including the Q3 and Q4. And this company, many of the company might actually start to see some of the pressure from the revenue generation, given the tariff impact, and also the hiking of unemployment rate here in the U.S. We might see some slowing down for the company's revenue creation, and we actually, to be more precisely, that we should actually see more of equality for the company revenue generation going forward, given the inequality of AI exposure to different sectors and different company in the United States. So this is a trend, whether we like to admit it or not. I think the AI inequality would actually cause some divergence here, even though you look at overall the market, like we might still see some positive surprise, but we would actually see some different, more of a wider distribution or dispersion of the surprise here in the different sector. That being said, if the sector is more exposed to AI, that we actually see more of the upside surprise versus like the sectors with low exposure to AI might see more of a smaller, like a dispersion. So that's is my observation and my projection.
Okay, just one last topic before we let everyone go, and we talked about government data before. We talked about inflation right now, and no one worries about it, because we can't get a higher CPI if we never get the CPI, right? But if we look at my take on that was that we get plenty of other data from the private sector that's telling us what's going on with both growth and inflation that we don't need, and employment. So we don't need the government data, but just as an example here, if we look within the ISM data, we get their prices paid. We look within the Empire Manufacturing, which is the New York Fed, we get their prices paid. We look within the NFIB data, so small businesses, we look at their prices paid. And for the most part this year, all three of those indices have gone up quite a bit. The only thing that really hasn't followed, which has stayed relatively flat, though it's turned up the last few reports before they stopped sending them to us, was the CPI data. The only thing that's lagging is CPI, but that's what the market's focused on, and that's why they say there is no inflation. So I guess maybe we'll just leave it with there. Tony, why don't you go first? When you see these other measures of prices where companies are telling you, or they're telling the New York Fed that we're going to be raising prices, how does that translate into no inflation?
Well, Yeah, apparently, given what the tariff policy adopted by the current administration, we might actually start to see some negative impact of the tariff. We don't get into the politics, so this is something that what we can see is higher tariff typically would lead to the higher end price. And if according to the report, that 57% of the hike of the tariff will be absorbed by the end consumer, that might actually lead to the lower demands. And lower demand in another negative cycle will actually lead to the lower price of the goods as well. So here is what we're going to see a very complicated the trade-off here between the higher end price versus like the lower or start picking up the CPI data. But we should see the CPI to be flattened off or may even actually trending lower if we do actually implement the high tariff. Now, I mean, the thing is, can we actually change this narrative? Yeah, there is an opportunity if President Trump can reach a deal with the presidency of China about either the trade or even about the commerce and other things. For instance, like if they reach to a deal, so then the Chinese government will actually buy more of a soybean from the Middle West. So the farmer will actually be happy with more of the capital they could actually spend on buying goods. So that might actually dry up the demand. But given like so many of the farmer have the hands like actually being tied up at this moment, it might be actually difficult to see how they can actually to lead to the higher demand. So here, it will be nice that hopefully that in the coming week, I think next week, we'll like to actually see a positive outcome from the President Trump and the presidency for the APAC meeting. But overall, regardless, like there might be some different impact over different region here. Well, some concerning factor definitely has emerged, such as the unemployment rate in California has already picked up to 5.5%. I think this is pretty much it's the highest reading since the COVID. I mean, the COVID is more of distortion, so this is something more of a concerning. We do see some higher the major impact of AI adoption, and simultaneously like people complain about the immigration policy here for certainly. Now, given all of this, I would say the coming 1 or 2 weeks will be very, very critical for the market. And if we actually do see some peace deal from between Ukraine, Russia, and we see some very nice like outcome from President Trump and President Xi, and President Trump always mentioned that President Xi is his good friend. So I would like to see if this good friendship will actually turn out to be a positive outcome to the market, to the economy.
Yeah, and I've brought up as you're talking the chart of soybeans, which to me is the #1 barometer of the U.S.-China trade relations, because China is the biggest buyer and the U.S. is the biggest seller. So, and as we've seen the last several days, the price has moved higher. I think to your point, in anticipation of a pretty good outcome in that discussion. For sure, it hasn't broken out. It's still well below the year's highs. It's importantly still very well below at less than $10.50 a bushel. The farmer's cost is between $11.50 and $12 a bushel. So the farmers are massively underwater still. And so that is something where there's probably a lot of political pressure on the president here in the U.S. to get a deal done because the farmers are losing money left and right. But Blaine, I want to get your thoughts on. Oh, I guess one other thing I wanted to mention. We talk about unemployment rate in California. And I want to paraphrase President Biden, who told the coal miners who were put out of work that they should need to learn how to code. I think we should tell the Silicon Valley engineers and government employees who are being put out of work, they need to learn how to build a house, because that's where we need the labor. It's not going to be there. And I think it's going to fall on the same deaf ears that President Biden's comment did as well. But anyway, Blaine, I wanted to get your thoughts on price levels and whether or not, as we said at the top of the hour, both markets concede that there's no inflation. It's all about growth. But here's some data, not government data, unofficial data, or private data, that's saying that maybe prices still aren't really contained. Last word to you, Blaine.
Yeah, well, thanks, Rich. And this has been my concern, right? I'm not out of the woods yet about being concerned about inflation, about price pass through. I'm really concerned about the non-price pass through, that the companies so far have been trying not to do that, and that eventually it's going to have to happen. And I think some of these indicators here on the the front end of the prices paid, kind of indicate that we're still at high levels. And just how much longer can this really continue without it being actually seen flowing through the rest of the economy? And so I take the CPI out of it, because you're right, who knows when we'll get that number. I think these other numbers, are glad we have them and can pay attention to them, because I think we still need to be concerned about that. And
Absolutely. Well, with that, we're going to end it. Thanks everyone for sticking around as long as you did and for tuning in. As you know, as we see right now, I think the biggest focus is going to be on earnings, and we'll get back together with you guys after a couple weeks of these earnings this week and next, to kind of summarize what we've seen, and if we've seen any change in narrative on growth, if we have any outcome from that summit at the end of the month between the presidents in South Korea. Those are going to be the biggest catalysts as we look the next 2 weeks. These mega earnings and that summit between U.S. and China, and perhaps the narrative will change to one of positive growth, year-end rallies, Santa Claus bonuses, and lots of toys, and not something that is decidedly less exciting than that. So, Blaine and Tony, thanks for joining me, and look forward to catching up in a couple weeks.
thanks,
Yes,
guys.
looking forward to that. Yes, thank you, Rich. Thank you, Blaine.